Well, hello traders, it's Dale here. I'm just going to do a quick video on the stop loss strategies that are implemented in the panel. We'll just quickly walk through those. It shouldn't take too long. So here's the stop loss section here. Okay, pretty straightforward stuff. We have our options here in the drop down box, and then we have the associated options with each stop loss strategy. So the first one's going to be candle high low. If you're selling, that means we're going to use the candle high. And if we buy, that means we're going to use the candle low. So if we targeted, this candle here, all right, if we press sell, we're going to use the candle high there. That's the stop loss price. And we're going to use the candle low here if we press buy, all right. There's a few options here. Obviously, we can target which candle we want to apply the stop loss strategy to. And remember from the other videos, we count backwards. So we start candle 0, 1, 2, and we count backwards in that fashion. That's an arrow there. And by default, it's set at candle 1, which means the previous candle there. All the strategies have this option here, which is add pips to stop loss. And that's basically a little buffer. If you say want to target the previous candle high, by default we have a buffer of 1 pip, and if you want to pump that up, obviously that's very simple, you just do that. So that will, whatever your stop loss is, it will add 10 pips to it. Okay, so you can apply a little buffer there. So let's do an example here. Let's just go for a breakout entry to make things simple. We'll target the previous candle, and we're going to do a stop loss. We'll set that back to 1. We'll do a stop loss at target candle 1. All right. If we click buy, we expect the stop loss to be at target candle 1's low there. So we go buy, and we can see that, and you can see the stop loss has been placed exactly where we expected. So we close that off. Now let's add 10 pips so we can see that buffer in action. So we click buy there, and we can see that there's the previous candle low. Here's where the actual stop loss is, and if we measure that out, we can see there's roughly about 10 pips there. Okay, so that's worked out quite nicely. And if we reset that back to 1, obviously if we click sell, we expect the stop to go above the high there. So we click sell. Now you got to remember, when you short the market, the stop loss, you exit at the ask price. So the panel automatically accounts for that. So what it does is it adds the spread onto your stop loss price if you're shorting. And that just basically stops any confusion. I've done a video on that explaining the difference between the bid and ask price and how it affects your orders. But basically all you need to know is the panel takes care of all that. So wherever you want your stop, although you asked it to put it at the previous candle high, you can see there's a little bit of a gap there where the spread's been added onto. That will basically prevent the stop loss from being triggered too early. Okay, and it also had the extra 1 pip added onto it as well. So let's do something a little bit more dramatic. We'll add 15 pips to that stop loss there. We'll click sell, and we'll see we definitely did get that 15 pip gap, but you can see it's actually, roughly about 17.5 because we have to add that spread on as well. And we're on the Euro US dollar, so the spread's fairly cheap there. So that's basically the candle high low. As I said, there's add pips to stop loss will be available with all the different strategies here. Then we got the manual stop loss price. Okay, this is fairly simple. We just say, all right, we want the stop loss around here, so 106.992. Okay, 106.992. I was wondering why we weren't getting a match there, and that's because we've added 15 pips to the stop loss there. So we'll cancel that. Actually, we'll just leave it there. We'll just add 1 pip on, and we'll press sell again. And there we go. So we've got our manual stop loss price plus 1 pip there. All right, and the spread is not added to a manual stop loss price. Okay, if you're going to use a manual, you're going to say right here is where I want the stop loss, and the spread is not automatically included in a manual stop loss price. Okay, it's just you telling the panel, I want the stop loss here, no exceptions. Okay, so we'll clear these out. Let's just add 0 pips onto that. And we should see the stop loss is exactly how we asked it to be. Okay, exactly the figure. All right, now I'm going to talk to you about a volatility stop loss. All right, this is a dynamic stop loss that works off the average trading range. So it's basically what it says, it's a volatility stop loss. So it places a stop loss size that is sort of in sync with the market volatility. So if you have a very volatile market, then the stop loss is going to be wider. If the market is trading very thin and we've got sideways consolidation, not much is happening, very dried up markets, then the ATR or the volatility is going to be very narrow, therefore the stop loss will be very narrow. So we're using the ATR for that, and its default period here is 20, and we have a multiplier here, so we can, we can adjust that. So we can, say if we want twice the market volatility as our stop loss, or 3 times or whatever, then we can apply the multiplier here. But times 1 doesn't do anything. It just basically replicates the value that you would normally get. But obviously, once you start going times 2, times 3, then you'll start affecting the figure there. Now, let me just pull up an indicator here. All right, don't get scared. I'm not going to go all indicator Nazi on you. What I've done is I've reprogrammed the ATR, very simple reprogramming, and I've actually told it, so let's put it to 20 so we can mirror what's on the panel here. Okay, so this looks a little bit different from your normal ATR. I like it like this because it visually presents better there. We can sort of see the volatility from the ATR here better as a histogram instead of the standard ATR, which is this. Okay, we've just got a thin line here, but I prefer this. So I reprogrammed the ATR just for demonstration purposes for this video, so we can visually see things easier. Let's zoom out a little bit. So what's basically happening here is, let me minimize that panel. ATR 20, okay, we can see when the market kind of spikes in volatility here, the ATR increases in value, so your stop loss would be wider. All right, and when the market goes very quiet, okay, we get a very quiet sort of period here. The candles aren't very large in range. We can see the ATR just dropping off the cliff there. If you used a volatility stop around this area, the value would be a lot less than, say, if you used it when, say, the volatility was a little bit wider and we got a bit of a peak there, okay? The higher the ATR value that you use, so if we add another one, and let's add one that's, I don't know, 70. So it's going to take the last 70 candles and get our figure. You'll find that the value is a little more smoothed out. Okay, we don't get these. Where's the 71? We don't get such dramatic spikes in the ATR value. It's more like sort of smoothed out. So you get a bit more of a broader view of the volatility of the longer term market, whereas ATR 20, is kind of a medium kind of view. Let's delete the 50 and let's add a 5 ATR. Okay, and you can see the 5 is very sensitive. All right, it's very sensitive. Turn that off. So if we get a spike in volatility here, we can see there's a very sharp reaction here, but in the ATR 20, all right, it's a bit more smoothed out. Okay, this is standard pretty much for all indicators. The lower the period, or the lower the amount of candles you tell it to scan, the more sensitive it's going to be. Okay, so depending on what you want to do there, this is just explaining how the panel is going to judge the volatility of the market and calculate the stop loss size. Also with this indicator, I programmed it to display in pips. Okay, so we can see the average volatility at the moment is about 33 pips here. Okay, it was previously about 45. You can see the ATR 5 is jumping around all over the place, going from 70, down to 33. So we're getting some dramatic changes there. So it's, probably better to use something a little bit more stable like the ATR 20. Now, when the panel uses a volatility stop loss, which reading is it going to use here from the ATR? Okay, we've got a lot of different readings here. It makes sense to use the previous candle's average trading range reading. So we'll be looking at the previous candle, looking back, in this case, 20 candles. Okay, so we'll look back 20 candles, and then it will calculate in that specific range what the average volatility was there, or the average trading range, and that's what we're using for our volatility index, basically. Also, we use the previous candle's value because it's locked in. The current candle's value is always fluctuating, so that's why we're always going to be using candle one's reading there for our volatility stop loss, okay? And the reading there is about 32, or just about 33 pips there. That's how wide we expect our stop to be. All right, so if we use use a breakout entry on the previous candle there, use a volatility stop loss, and turn that off. If we hit sell, opening a pending order, if we just measure our stop loss there, it is about 37 there, plus we've got our extra pip added onto that, okay? So it takes our entry price and adds in the 33 pips there. Because we're selling, we're adding the spread, and we're also adding the extra pips there as well. So let's cancel that. Now if we want that to be wider, we want it to be twice the ATR period, then we can use the multiplier here. We do that again, we should have a stop loss size that's basically nearly doubled, which is true. So we're just going to get that right on there. So about 71. So it'll be about 33 times 2. It's about 66, which is about, roughly about there. And plus our spread, plus our add pips to stop loss there. So that's just about right, okay? It should be the same if we add a buy order as well. We're going from the breakout of the previous candle high down, and we get about the same here. This time we don't add the spread on, so it's roughly about 66 around there. Okay, so we can see that's working quite well there. And that's really it. That's the volatility stop for you. Depending on what's going on in the market, that's going to affect the size of the stop loss. So it's sort of like a dynamic stop loss size that adjusts to market conditions, and you can obviously use the multiplier to widen that if you need to. If your stop's a little bit too short, you can multiply it up a bit and buffer it up a bit there. Okay, so that's it. That's the stop loss options. And so in the upcoming tutorials, I will talk about the trailing stops as well, where we also do have a trailing stop by volatility as well, which works very similar here. Okay, so I'll see you in the next tutorial.